Okay, the purpose of this video is to show you how to do Unit 4, Activity 5. And the concept covered in this unit activity is closing entries. Closing entries are the last step of the accounting cycle. So congratulations, this is not the last assignment we'll do, but this is the last kind of skill that we need to add to our collection of accounting skills to be able to do one full accounting cycle. So it's good. This is a milestone here. So this assignment gives us the, what would you say, the task of completing a closing entry for this business, Ramon's Legal Services. And so what I'm going to do in this video is hopefully show you how to complete this assignment, and along the way kind of describe what closing entries are, what the point of them are, and how to do them in the future. All right, so closing entries. What this has to do with is closing out certain accounts within a business at the end of the financial year. So this is when you're wrapping everything up and you're trying to come up with a closing balance for the business so that you know how much money overall the business has made, or how much money overall the business has lost for the year. And in order to do that, we need to close up some accounts that affect that closing balance or that ending balance for our business. And those are temporary accounts. So we have to close or get rid of our temporary accounts. And those are obviously set aside or different than our permanent accounts. So there's kind of two groupings or two classifications, permanent accounts and temporary accounts. Permanent, like their name suggests, you get to keep around and carry over into the next accounting cycle and into the next accounting year or financial year. Temporary accounts you close, and then you start off new in the new year. So closing entries has to do with getting rid of those temporary accounts or zeroing them out so that they no longer exist, and so you don't have them around, hanging around for the next financial year. So the question then is, what are our permanent accounts and what are our temporary accounts? If you look at this worksheet that we've been given for our assignment, the Ramon's Legal Services worksheet, you're going to see that we've got certain accounts in kind of this orangish color, and we've got certain accounts in the blue color. The accounts in the orange color are our permanent accounts, and those are ones that stick around. So those are our asset accounts, our liability accounts, and our equity accounts. And so if you see those are all in orange, and all of those are recorded on the balance sheet, right? So there is an acronym for that. Some people go by ALE. So L, E, A being for assets, L being for liabilities, and E being for equity. And then that acronym actually lines up with our temporary accounts. So just trying to get in a little closer here. All right, so the acronym for our permanent accounts are assets, liabilities, and equity. Those are the ones that you're used to from the very beginning of the class. Those are the first things you learned, right? And then our temporary accounts are more of those accounts that we kind of added as we went along, or as we got further into the course. And so those are our revenue accounts, our expense accounts, and our drawing accounts. And so the acronym for that is RED. Revenue, expenses, drawings. And so if you put those two acronyms together, it's RED ALE. So if that kind of thing helps you to remember these things, feel free to use it. Red ale. If it doesn't, don't use it. All right, so all right. So temporary and permanent accounts. Temporary are the ones that we're going to be focusing on most in this assignment. And those are the ones, as I said, we're going to be getting rid of or zeroing out along the way. All right. So with that in mind, the temporary accounts are the ones in the blue here. So if you see these totals and then you go over to the account names, you're going to see that we have the drawings account. Fees earned, that's a revenue account. That's the money that we've made over the year. And then we've got our expense accounts, which, as the name suggests, is the expenses. So those are our three styles of temporary accounts that we got to get rid of. And when I say get rid of them, I mean we got to bring the balances down to zero. And so the question is possibly, well, how do we do that? And it's going to be through a series of different journal entries. So if you look down here at the bottom of the worksheet, you're going to see that we have three different tabs, one for the worksheet that we're looking at, one for journal entries, so a general journal, and another one, which is a trial balance sheet. And so all three of these we've worked with. We just haven't done closing entries with these. So that's what we're going to work on now. So what I'm going to do is I'm going to open up the journal tab and I'm going to put it in its own window. That way we have it side by side. And I'll just show you what the journal entries look like that help us close our temporary accounts, our revenues, expenses, and drawings accounts. So I'm just going to go to the journal, then I'm going to open the new window. And I'm just going to size this so that it can sit next to our worksheet. So we can pull the numbers off the worksheet and put them onto our journal if necessary. So having it close by for reference. Okay, so I got that going. And so the first thing that we're going to do with our journal is we're going to do a journal entry that will allow us to empty out our revenue account. And in this case, we only have one revenue account. In other businesses, there might be a couple revenue accounts, but in this one, it's fees earned. So since this is a service business, we've earned money over the year doing services for other people or other business. In this case, it's Ramon's legal services. So I assume he's like a lawyer or something like that. So for all of his legal work, he has received $80,000 in revenue. So he's made $80,000, doing legal things for people. All right, so what we're going to do is we're going to empty out this revenue account and we're going to put it into another account using a journal entry. And so over here on my journal, I'm going to start off my journal entry just the way I would any other journal entry with the date there. And then in the particulars, I'm going to put the name of the account that I'm trying to close, which in this case, as I said, is the fees earned account. And then remember that our first journal entry is always a debit. And so we're going to be debiting the entire amount of money that is in our fees earned account. So if you see this, this is a revenue account. So it's a credit account. So anytime you add to it or you want to increase the balance, you add it with using a credit. So the same applies if you want to decrease this revenue account, this fees earned account, you debit it, which is if we want to get this account down to zero, we would debit the entire amount that's in that account right now, which, as I said, is 80,000. So we'll take that and we will debit this for 80,000. And then the question is, well, if we're taking all of that money out of the revenue account or out of the fees earned account, where are we putting it, right? If we're getting rid of this one account, the money just doesn't disappear. It has to be put somewhere, right? With our journal entries, we always need to have a debit and a credit. So what we do when we're closing entries is we create out of thin air a new account. And this is an account that you guys wouldn't have learned about yet or wouldn't be familiar with yet. But it's called the income summary account. And we only create it at this very moment in time when we're doing our closing entries, and we get rid of it really quickly as well. And so I'll show you how we do that a few steps from now. But for now, we have this new account and it's called the income summary account. So that's what we're going to credit. So income summary account, and we're going to credit that for 80,000. So essentially we're taking all of the money out of our fees earned account and we're putting it into this temporary income summary account. So now that we've done that, our fees account is gone, it's zeroed out, it's empty, it is no longer existing as far as we're concerned. And we have this income summary account, which now has been credited for $80,000. So now we're going to do the same process for our next set of temporary accounts, which in this case are our expenses, our expense accounts. So all of these here, they're the ones that are also in the blue here on the income statement. And so this journal entry is going to be very similar, except for you'll notice that the expense accounts, all of their totals are being carried in the debit column. And that's because anytime that you increase an expense account, you debit it, right? So it's a debit account. So in order to empty all of these, we have to do a credit for that amount. And so our debit in this case will be the income summary. So on our last one, the income summary was the credit. On this one, the income summary is going to be the debit. So that'll be our first thing. And actually, let's see. I'm just looking for our indent buttons here. And so I forgot on our income summary for the first one, we need to indent that so that we know that it's a credit. All right. And so our first one is the income summary for our second journal entry. And then we just need to figure out how much we're going to be doing the debit for. But we don't know that yet because we don't know what the total of all these expense accounts are. So what I'm going to do is I'm just going to pull all of these out of here. And I'm going to put them over here in the credit column. Hopefully that works. Maybe it won't. Let's see. Oh, okay, I see. It won't let me take those over because they are part of a formula. So I'll just type them over. But basically, we're going to have to add all of these numbers up to figure out what our total expenses are, which we will then debit on our income summary. So I'll put that in there. I imagine at this point, you guys will be hitting the fast forward button or the skip 10 seconds ahead button on YouTube, which is totally fine. I'll try not to breathe too heavily while I'm doing this. These are all things that teachers get self-conscious about when they're on video chat, which I'm sure you guys probably do too if you're ever forced to do it. The other thing that's probably happening is some of you are probably screaming at your computer screen because you know how to copy these over more efficiently. Just hit control, whatever. Okay, I think that's all of them. And then I'm going to try to do the copy and paste here. Let's see if this works. Hopefully it will. All right, cool. So I've got all the expenses there, and the only thing I need to make sure that I do is indent those so that we know that they're credits. And then I'm just going to figure out how much all of these are together. So hopefully my auto sum works. It does, and that's the correct amount, which is great. So $16,262.16 is the total amount of all of our expenses. All right. So that is what the journal entry looks like for getting rid of our expense accounts. So basically, we just do the opposite of whatever the expense account is. So in this case, those are all debit accounts on our income statement. So we want to credit them to bring that account down to zero. And we want to send all of that money that it was accounted for into our income summary account, which we just created moments ago, as you remember. All right, so now we've got that sitting there. The next thing that we want to do, which is, as I said, our income summary account is going to be very, it's going to have a very short lifespan, and we've already reached the end of that lifespan. So, let's see, why is it doing that? Okay. Tried to get fancy with my Excel and it messed me up. So let me put this back in here. Okay. So now the next step, step number 3, is to get rid of our income summary account and put the money that's in there into our closing capital account. And so our capital account is something that, that we've had all along. And so that's something that you're probably familiar with. You'll see that we have our capital account over here on our worksheet, far left there in column B, cell 20, Mike Murphy Capital. So what we're going to do is we're going to empty our newly created income summary account into our capital account. And then that one goes away, never to be heard from again until we do closing entries again at the end of the next accounting cycle. So income summary account goes away, and all of the money that we emptied into it will then go into the capital. So this is the way we do the journal entry to account for that. Again, we put in 31 for the date. So it's August 31st, end of this accounting period. And then we have our income summary account, which should have a credit balance because right now we have 80,000 in the credit column and 16,000 in the debit column of our income summary. So to figure out how much we have in there or that we're taking out, all we have to do is subtract 16,000 to 6216 from the 80,000. So basically all you're doing is you're subtracting this year's expenses from this year's revenue, or the fees earned. So subtracting the amount that we spent on business this year from the amount that we made on business. And this will tell us, how much we made over the course of this year. So I'll get my calculator out and we'll do that simple calculation. So we made 80,000 this year and we put it into our income summary account just a few moments ago. And then we spent 16,262.16. And so that's 63,737.84. So that is our net income for this year. And we are going to be putting that, as I say, into our capital account so that we can have our closing capital balance. And so that is going to be our debit for this journal entry. Because as I said, we have a credit balance in the income summary account. Most of the money was in the credit side of that 80,000. So it's the income summary. Just gotta fix the indent on that because it's the debit. And we put in that number that we calculated there, the 63,000. And then we credit the capital account with that same amount. And so that's in effect putting this amount into our capital account through a journal entry. And so our capital account, as I said over here, is Mike Murphy Capital. And we will indent that because it is a credit. And then we put this same amount there, 63,737.84 on the credit side. So remember, capital account is a revenue account, and revenue accounts, or I'm sorry, is an equity account, pardon me. Capital accounts are equity accounts, and when you add to an equity account or you increase an equity account, it's a credit. So we're crediting this capital account with $63,737.84. So we're adding to that account. All right, and we are almost done. We just have to do one more journal entry and then we move on to the trial balance sheet. So the last thing that we have to account for is our last temporary account, which is our drawings account. And so on that one, we have to look at how much our drawings are. And in this case, it is $20,000. You'll see that on the worksheet there in the blue. It's the first one that we skipped. And so we're dealing with the drawings at the end because we're going to just take these right out of the capital account that we just added to. So this will affect our drawings account and our capital account, this next one. And so we're getting rid of our drawings account. So again, we're just going to put in our date, August 31st, and then we are going to debit our capital account. Mike Murphy Capital. And again, I gotta scroll over and hit the indent button. So this is going to be a debit for $20,000. And the reason it's going to be a debit is that this has the effect of decreasing our capital, because remember, drawings are when the owner took money out of the business for personal use. So over the course of the business year, the owner took out $20,000 from the business for personal use. And so it's no longer in the business. So we can't count it anymore. And also, if we debit this, that means we're crediting our drawings account. And our drawings account, anytime you want to increase a drawings account, you debit it. And anytime you want to decrease it, you credit it. And remember, we want to close out our drawings account. So we want to credit it for everything that's in there, which is this $20,000 that we already spoke about. We'll just indent that. And that's ready to go. Okay. So now, after all that, we've gotten rid of our revenue accounts, our fees earned account, and we emptied that into our income summary account, which we created just now, one that, like I said, you weren't familiar with. And then our next step was to do a journal entry that emptied out our expense accounts, and we emptied all of those out into our income summary account again. And then we destroyed our income summary account. We got rid of it almost immediately, right? So it was only a thing for the space of 2 journal entries, and then we got rid of it, right? So we emptied out the income summary account that we just created into our capital account. And then our capital account, we subtracted our drawings from it, right? So our $20,000. And so in doing that, we got rid of all of our temporary accounts, and we've basically created what will be our ending balance, or our final balance, or final capital balance for this financial year. And so the last step of this whole thing is to do the trial balance sheet. And this is basically where you kind of check your work and make sure that everything you did makes sense and that it balances in the end. So we didn't put any amounts in the wrong spot or any numbers in the wrong place or anything like that. So the trial balance is useful for kind of checking your work and making sure that everything you did balances. So we will click off the journal and we'll go over to the trial balance. All right. And so for this one, all we're doing is transferring over our permanent accounts and then including our ending capital balance as well, which we worked on calculating here in the journal. So once we get down to that, I will show you what's going on there. So our permanent accounts, as we talked about at the beginning of the video, those are the ones that show up on the balance sheet. And so those are these here, the ones in the orange from the worksheet. So I will copy these over. And hopefully they copy without any drama, which they do, which is great. And then we just got to transfer the amounts from these accounts here. So there's nothing special going on here. We're just literally copying these numbers over. And so as we discovered before, I wasn't able to copy and paste them. So I'll just simply type them over. So remember, these permanent accounts are our ALE accounts, right? Assets, liability, and equity. And I'm going to stop just short of putting in the capital account amount because, as I've alluded to, that is now changed based on the journal entries that we did, right? So we changed our capital amount. So we want that to be reflected in the trial balance. And so over here, you're going to see that it gives you a hint as to how this should be calculated, or how this closing balance, capital balance, should be calculated. So basically, you take the opening capital balance plus the net income minus the drawings. So for us, those numbers are these. Our opening capital balance comes from the worksheet. It's this one right here, the $13,705.30. So that's how much we started with in our capital account before we started doing our closing entries, before we did our journal entries. So that is opening balance. And then our net income. Net income is what we calculated when we were closing up our revenue accounts and our expense accounts. So if you go over to the journal, remember that we had 80,000 in revenue and $16,262.16 in expenses, which we did the calculation for, and we came up with the number of $63,737.84. So that is our net income. So I'm going to copy that. I'll put that here. And then our drawings. Our drawings were $20,000, which again, we got from the worksheet, from that very first row in the blue area there. And those were 20,000. All right, so I'll get out my calculator and we can figure out what our closing capital balance will be based on those numbers there. And remember, we're doing opening balance plus net income minus drawings. So let's see. 13,705.30 plus 63,737.84, and then minus 20,000. All right, and so that equals $57,443.14. So that right there is our closing capital balance. And when we put that in, we see that these two numbers balance, which means that we've done everything correctly and everything has been put in right, and we don't have an imbalance on our trial balance, which is exactly what we were hoping for. And I believe the hint said that that was supposed to be our number. So yeah, all is well. We did it correctly. And so at that point, you have ended the accounting cycle, and your business is ready to start a new financial year, and you can reopen all sorts of temporary accounts. You can make new expense accounts, you can make new revenue accounts, and a new drawings account for the new financial year. But you've gotten rid of all of the old stuff from the last year and figured out how much exactly, or how much capital exactly your business has to work with, and everything like that. So that is basically it for closing entries. I hope this video helped you out, and at the very least, hope it helped you finish this assignment. I will see you guys next time.